Hi guys, Ian Johnson from driversuccess.com. Today we're going to talk about the difference between financing your receivables through a bank and financing your receivables with an asset-based financing solution called Receivables Factoring. Okay? So the reason why I'm doing this today is because I had a couple of customers ask me, how do you do the comparison, how do you do the analysis, and what are the benefits to factoring? So we're going to do that today. And this example, this entire example, is available on my website, driversuccess.com. There's a sample Excel spreadsheet that has this very same example, and you just need to input the different variables in terms of your interest rates and the days it took to collect on the invoice, okay? So very quickly, with a bank, when you finance, they're going to charge you a cost of capital. So in our case, our yearly interest rate is 6%. Our daily interest rate is 6% divided by 365 days in a year, which gives us 0.0164%. Our cost of goods sold is $10,000. Our daily financing cost is our daily interest rate times our cost of goods sold, which is $1.64. It took 45 days to collect from our customer, so it's 45 days times our daily cost to finance the receivable. It gives us 45 times $1.64 is $73.97. Very simple and straightforward, not too complicated. Now, how does receivables factoring differ? So we're going to go through how the calculation is done, and then I'll explain exactly the process that the receivables factoring company does in terms of how it handles the collection portion with your customer. Okay? Right off the bat, with receivables factoring, what you are doing is you are selling your receivable to a financing company. In turn, they're going to basically advance you capital based on a percentage of the receivables value. In this case, we've assumed that the company is going to give you an 80% advance, but it could be 90%. That advance depends upon, your risk tolerance as a company, what you're willing to absorb, what you feel comfortable with, and the type of program you work out with the financing company. Okay, so our receivables value is $15,000. We get an 80% advance of $12,000. Okay, so that's capital that we get into our hands immediately. And right off the bat, the first difference is the financing company is going to charge you an administration fee. Now, it's typically 1%. It could be 1.25 or 1.5. But this 1% is applied against the receivables total value of $15,000. So your first cost is $150. Okay, that's the first cost. Now, the second portion of their cost is how they come up with how they charge you a daily cost of capital against the advance. Okay, with bank financing, you're covering a cost to finance your receivables against the cost of goods sold. But with receivables factoring, it's a cost that's applied against the advance that the company gives you. Okay, so here's the second difference. The effective rate that they charge you is made up of the interest rate and the going prime rate. Now, I'm going to put a little star here because it's a good idea to track the prime rate just to make sure that the financing company you're working with is giving you good rates. Okay, so you can always check what the going prime rate is. So we're just going to take the same assumption in terms of 6%. 6%. Again, daily rate is right here. Our daily financing cost is this percent multiplied by the advance we get, which is $1.97, which accounts for the difference in terms of the financing. We're financing with COGS and with the bank at $1.64, but we're financing with receivables factoring against the advance, which is $1.97. Again, 45 days to collect on the invoice. Cost of finance in this case is 45 days times $1.97, gives us $88.77. And this second portion in terms of the difference is summarized in the charges to use factoring, which is $88.77 plus the $150. Okay, so this $237 includes the administration fee of $150 plus the $88.77 on the financing costs against the advance. Now, right off the bat, people see a higher cost with factoring and they're apprehensive. And yes, it's a higher cost. But there's one important thing that you have to remember. With factoring, the cost of financing is applied against the advance, which is $12,000. With bank financing, you're financing the cost of goods sold. So there's a $2,000 delta there, and that accounts for some of the difference in terms of the added cost. But even with that added cost, there are basically 4 essential reasons why companies are turning to factoring. Okay, number one, it's not a loan. Okay, it's not going to appear as a loan on your balance sheet. It acts like a loan. It's an immediate infusion of capital, but it's not a loan. Number two, your company's credit rating plays no role in the decision of the financing company to advance you capital. The financing company's concern is with the account debtor's credit rating. which is your customer. So if your customer takes 90 to 120 days to pay, it doesn't matter as long as they pay. So that's the second benefit. Your credit rating doesn't matter. The third benefit is, look, getting a $12,000 capital advance on your receivables value, getting that infusion of capital, you can do a lot of things with that money. You can lower your operational costs, you can lower your inventory management costs, you can lower your per unit freight costs on incoming parts, you can lower your purchasing prices, you can get prompt payment discounts from vendors and creditors for paying early. There's a lot of things you can do with that, and you can basically drive down the added cost by using that money to get better terms with your own vendors. And finally, the fourth benefit is, to be quite honest with you, companies need to have alternative financing sources, okay? You may decide, I'm going to keep some accounts in-house. I'm going to keep financing through a bank because I've got a pretty good credit line, but I can't get a higher credit line. And so for those customers that take longer than 45 days or 30 days to pay, I'm going to go with Receivables Factoring. So yeah, by all means, keep some accounts in-house. The guys that pay within terms, keep them in here. Use factoring with the rest. So that's it. This is available on the website, driversuccess.com. So that's it. Ian Johnson, driversuccess.com. Bye-bye.